One more question on cash flow. Following are the summarized balance sheets of Lotus Limited on 31st March 2011 and 31st March 2012. This is not in the standard Schedule 3 format. This is a summarized form of the balance sheet. And then they have given the additional information. We are required to prepare a cash flow statement for the year ended 31st March 2012 as per Accounting Standard 3 by using indirect method. So if it is indirect method, then we will have to start with the profit before tax in operating activities. So cash flow statement for the year 2012. Cash flow from operating activities first. Net profit before tax. Now how you will calculate net profit before tax? You have been given profit and loss balances, which is 4 lakh and 4,80,000. So that means your accumulated profit balance has increased by 80,000 rupees. Now this must be obviously after making a provision for taxation, but you want profit before tax. So look at the profit provision for taxation. It has increased from 50,000 to 60,000. Now in that case, what you have to do is you have to prepare one working note for provision for taxation. Prepare an account. So provision for taxation account. Your opening balance is 50,000 and closing balance is 60,000. Correct? This is how you will show, because provision for taxation account will be having a credit balance. And then if you look at the additional information that is given, they are saying not income tax paid, they are saying income tax provided during the year is 55,000. So if it is provided, that means it is a new provision that has been made. How do you make a new provision for income tax? In that case, you will debit profit and loss and credit provision for taxation account. So credit provision for taxation account 55,000. So 50,000, that is your opening balance, 60,000 which is your closing balance. 55,000 is the new provision that you have made. So obviously the remaining figure will be nothing but the tax which is paid, which is 45,000. So that closes your account. Now because you want profit before taxation, whatever you have debited in profit and loss by way of making a new provision, that you will have to add back. So 55,000, which is the new provision that you have made, that will be added to 80,000, which is the profit after tax, so that you will get profit before tax. So 80,000 plus 55,000, 1,35,000, that is your profit before tax. Then as I said earlier, all non-cash items, expenses will be added back. Now non-cash expenses typically include mainly depreciation. Let us look at land and building account first. You have 4 lakhs and 3,80,000. So 4 lakh is your opening balance, 3,80,000 is your closing balance. Then they are saying depreciation depreciation written off on land and building 20,000. So that is why 4 lakh has come down to 3,80,000. That means there is no other transaction as far as the land and building is concerned. So depreciation on land and building that was debited earlier in profit and loss, that you will reverse because it is a non-cash item. Then the next fixed asset is machinery. Opening 7,50,000, closing 9,20,000. And then they have also given something about the machinery additional information. During the year, company purchased a machine for rupees 2,25,000. They paid 1,25,000 in cash and 10,000 equity shares. So let us prepare machinery account to find out exactly what is the balance, what is the depreciation. Opening balance given in the balance sheet 7,50,000, 9,20,000 is your closing balance. Correct? That is as per your balance sheet. Then they are saying new machinery was purchased for 2,25,000, and for that 1,25,000 is paid in cash. The remaining 1 lakh is paid in the form of equity shares. So the entry is basically machinery account debit to cash 1,25,000 to equity share capital 1 lakh. So machinery account debit to cash 1,25,000 and to equity share capital 1 lakh. Now when you close the machinery account, this total is 9,75,000, but this is only 9,20,000. That means there is a balance which you will have to write on the credit side 55,000. And that is what is the missing figure in this machinery account? Nothing but depreciation. So now you get the depreciation on machinery, which is 55,000. So depreciation on machinery 55,000, that will be added back. There are no other non-cash expenses. This is the profit on investment, but this is not credited to profit and loss account. It is credited to capital reserve. That is why you don't have to do anything in the operating activities as of now. So that covers all your non-cash and non-operating items. So that gives you the total figure of 2,10,000. So this is operating profit before working capital changes. Now you will make the changes as far as the working capital is concerned. Working capital basically consists of current assets minus current liabilities. So stock 3 lakh, it has come down to 2,80,000. So that means it is increase in cash, decrease in the asset. So that means you will basically, if it is increase in cash, that means you will add. Decrease in stock 20,000. Then you have debtors. Increase from 4 lakh to 4,20,000. That means it is increase in asset, so decrease in cash. So you will deduct 20,000 less. No other current assets. Cash and cash equivalents will be basically your opening and closing balances. Then coming to current liabilities, creditors 5 lakh has gone down to 4 lakh. That means the creditors are paid back. That means it is cash outflow. So 1 lakh you will deduct, less 1 lakh. Decrease in creditors. So no other current liabilities. Provision for taxation, we have handled that separately. So after doing plus minus, what you get is 1,10,000, which is a positive number. So that is why it is cash generated from operating activities. But this is before tax, because income tax which is paid, that is not yet deducted. We have already calculated that here in the account. Income tax paid 45,000. So if it is paid, that means it is cash outflow. So cash outflow minus 45,000. So finally you get net amount 1,10,000 minus 45,000, 65,000. That's your positive number. So it is net cash generated from operating activities. Now coming to investing activities. Investing activities means non-current assets. Nothing as far as land and building is concerned, because the only change that happened was because of the depreciation. Then machinery, we have already prepared the account. Let us look at that account again. What's the change in terms of the cash and cash equivalents? This is what you have paid as cash for purchasing the machine. So this is your cash outflow. Remaining 1 lakh is not outflow in terms of cash or cash equivalent, because you have issued share capital. So this will not come in your cash flow. 1,25,000 is your cash outflow. So purchase of machinery 1,25,000. Because it is cash outflow, it will be negative number. It will be deducted. So investment, which is originally 1 lakh, that has come down to 50,000, and they have given the additional information. The company sold some investments at a profit of 10,000, which was credited to capital reserve. So this 50,000 investment which has come down, that is because of the sale of investment, and it is sold at profit of 10,000. That means it is actually sold at 60,000 rupees. So that means the money that the company has received is 60,000 rupees. That is why it is a cash inflow from investing activities, 60,000. Then as far as other non-current assets are concerned, no other change. So we can close the cash flow from investing activities, total of 65,000 negative. That means it is net cash. It will be net cash used in investing activities. And then finally the third category, cash flow from financing activities, which will be basically for your equities and non-current liabilities. Equity share capital 10 lakh has gone to 12,50,000. That means it is 2,50,000 issue of shares. Now out of 2,50,000 issue of shares, 1 lakh is because of the issue for consideration other than cash, because we have purchased machinery. So out of 2,50,000, which is the difference between the two, 1 lakh, for 1 lakh rupees, company has not received any money, because company has received machinery. That means the money that company has actually received is for rupees 1,50,000, and hence in financing activities you will have proceeds from issue of shares only 1,50,000, because remaining 1 lakh rupees is for consideration other than cash. Then let us see what else is the non-current liabilities impacting your cash and cash equivalent. This 10,000, which is basically capital reserve, that is the profit on investment, sale of investment, that we have already seen. Long-term loan from the bank, 5 lakh has gone down to 4 lakh. That means it is loan repaid. That means cash has gone out. So bank loan repaid 1 lakh negative, because it is cash outflow. So no other change in the financing activities. So both put together 50,000, it is a positive number. So it is net cash from financing activities. All three put together 65,000 minus 65,000 plus 50,000. That will give you 50,000, which is a positive number. So it is total cash generated during the year. Add your opening cash and cash equivalents, which is 2 lakh and 3 lakh. So that gives you 5 lakh, which is your opening cash and cash equivalents. Add that to the total cash generated during the year, you get 5,50,000, which is your which should tally with your closing cash and cash equivalents. So 5,50,000. Let us see. This is your 1,40,000 cash in hand, and 4,10,000 is cash at bank. So total 5,50,000. That tallies with our cash flow. That means our cash flow is correct.